The unemployment rate is 4.3%. GDP grew in the most recent quarter. The stock market is near all-time highs. By every metric the financial media reports, the economy is healthy. And yet the person watching this video probably doesn't feel like the economy is healthy. Groceries cost more than they did 3 years ago and haven't come back down. Rent takes a larger share of the paycheck than it did in 2020. The job market feels frozen, with hiring freezes spreading across tech, finance, and professional services. The gap between what the numbers say and what life feels like is the subject of this video. Because that gap isn't a coincidence, it's structural. And it's the place where recessions hide until they become too obvious to ignore. I'm Warren. 24 videos built the system. Pyramid, routine, rules, portfolio, protocol. This video is a stress test. Not of the portfolio, which was stress tested in the Japan carry trade video and the oil crisis video. This is a stress test of the person. Because the hardest moment in investing isn't a market crash. It's the slow, grinding period where the headlines say everything is fine, but the lived experience says otherwise. That dissonance is where people make mistakes. And the mistake, as always, is the same. They sell. Recessions are always declared retroactively. The National Bureau of Economic Research, the organization that officially dates recessions in the United States, doesn't announce a recession while it's happening. They wait 6 to 18 months, gather comprehensive data, and then declare what already occurred. The 2008 recession started in December of 2007. It wasn't officially declared until December of 2008, a full year later, after Lehman Brothers had already collapsed, after the S&P 500 had already dropped over 40%. The 2001 recession began in March. It wasn't declared until November. 8 months of living through a recession before anyone in authority confirmed it was happening. This methodology means that a person could be sitting inside a recession right now and the official data won't confirm it for months. That's not a flaw in the system. It's the design. The NBER requires comprehensive confirmation before making the call. By the time the call is made, the person who reacted early has already sold at the bottom, and the person who stayed invested has already begun recovering. If you remember nothing else from this video, remember that. The official declaration is always late. The market moves first, the data follows, and the investor who waits for confirmation before acting has already missed the worst of it. The unemployment rate is the most widely cited economic indicator, and it's also the most misleading. At 4.3%, it sounds healthy. But the number only counts people who are actively looking for work, defined as having applied for a job within the last 4 weeks. Since the pandemic, more than 1.6 million Americans have stopped looking entirely. They've dropped out of the labor force. They don't appear in the unemployment rate because they're not counted as unemployed. They're counted as not participating. The labor force participation rate has dropped to 61.9%, the lowest since December of 2021, and still below the pre-pandemic level of 63.3%. The headline number says the job market is fine. The participation number says over 1.5 million people gave up. The quality of the jobs being created tells the second part of the story. Full-time positions are being replaced by part-time gigs. And the way the government counts this is genuinely worth understanding, because it explains why the numbers feel disconnected from reality. If one full-time worker earning $60,000 gets laid off and takes 2 part-time jobs at $15 an hour each to stay afloat, the labor statistics count that as 2 jobs added. Net job growth. The person's income dropped by roughly 40%. Their benefits disappeared. Their financial security collapsed. But the headline says the economy added 1 net job. Roughly 4.4 million Americans are currently working part-time because they can't find full-time work. They're employed in the statistics. They're struggling in their bank accounts. If you're watching this and your own experience matches that description, if the job market feels tighter than the numbers suggest, if the raises aren't keeping up with the prices, the numbers aren't lying exactly. They're measuring something different from what most people think they're measuring, and that difference is where the gap lives. The consumer side of the data tells the same story through a different lens. Credit card debt hit a record $1.28 trillion at the end of 2025. The average interest rate on those cards? Roughly 22%. Americans aren't swiping for luxury. They're borrowing to cover the basics. Cumulative inflation since 2020 has risen over 25%. Wages have grown, but not enough to close the gap for most households. The result? The personal savings rate has dropped from a historical average of roughly 8% to 4.5%. That means the average American household is saving less than half of what it used to, while borrowing more than it ever has at interest rates that compound the problem every month. If you're carrying credit card debt right now, the math from video 4 applies directly here. 22% interest on a $6,000 balance costs $1,320 a year in interest alone. That's $110 a month that goes to the bank instead of to the snowball. Every month that balance persists, the compound curve from video 15 loses $110 of potential mass. Over 20 years, that monthly leak costs roughly $84,000 in foregone portfolio growth. The credit card debt crisis isn't just a macroeconomic indicator. It's a direct attack on the architecture this series built. The pyramid from video 7 puts debt elimination before investing for exactly this reason. This is the pattern that precedes every consumption-driven recession. Households stretch to maintain their lifestyle. Credit expands. Savings shrink. And the whole structure holds until something triggers a pullback, a layoff, a medical bill, a car repair that pushes the credit card past its limit. In 2007, the media celebrated strong consumer spending right before the entire system collapsed. The spending wasn't strong, it was borrowed. And the borrowing was unsustainable. The credit card data in 2026 looks uncomfortably similar, not identical. The housing market isn't in bubble territory the way it was then, but the consumer balance sheet, the gap between income and spending, and the reliance on revolving credit to bridge that gap are following the same trajectory. Here's the concept that ties the entire gap together, and it's the most important idea in this video for anyone trying to make financial decisions based on the news. It's called Goodhart's Law. The principle is simple. When a measure becomes a target, it ceases to be a good measure. Once policymakers, institutions, and markets start optimizing for a specific number, they stop optimizing for the reality the number was supposed to represent. The unemployment rate is a target, so the system optimizes for a low headline number, not for job quality, not for labor force participation, not for whether the person working 2 part-time jobs can pay rent. GDP is a target, so the system counts credit-driven spending the same as income-driven spending. And both contribute to growth, even though one is sustainable and the other is a ticking clock. Inflation is a target, so the system manages the index that measures it rather than reducing the actual cost of living, which is why the official inflation rate can decline while groceries still cost 25% more than they did 3 years ago. If you've ever looked at a headline that says, "The economy is growing," and thought, "Growing for whom?" that's Goodhart's Law operating in real time. The economy the numbers describe and the economy people live in aren't the same economy. They used to be closer. They've drifted apart over decades of metric optimization. And the distance between them is where recessions hide before the data catches up. The result of Goodhart's Law applied to economic metrics over decades is exactly the gap this video is about. The numbers say one thing, the lived experience says another. And the distance between them grows wider every year because the system keeps refining its ability to hit the target number, while the underlying reality drifts further away from what the number was supposed to capture. When the media celebrates job growth, the person who understands Goodhart's Law asks about job quality. When they report wage growth, the informed viewer checks it against cumulative inflation. When consumer spending looks strong, the data-literate person checks the credit card balances. Because there's always more to the story than what the headline captures, and the Conference Board's leading economic index, which is specifically designed to predict recessions by aggregating 10 forward-looking indicators, has been declining. Consumer expectations have retreated. Building permits have softened. Manufacturing has contracted. Credit card delinquency rates have risen to their highest level since 2012. Commercial bankruptcies are up over 7%, with more than 24,000 filings, the highest in over a decade. Each of these indicators individually could be noise. All of them together form a pattern, the same pattern that appeared before 2001 and before 2008. Now, what does this mean for the person who built the system across 24 videos? 3 things, and they're the same 3 things from every threat video in this series. First, the portfolio was designed for this. VTI holds the entire US stock market. During recessions, some sectors contract while others hold or grow. Healthcare, utilities, and consumer staples tend to be more resilient. Technology and consumer discretionary tend to suffer more. The index holds all of them. The net effect is that the portfolio declines less than the worst performing sector and recovers faster than any individual stock. If you hold VTI through a recession, the portfolio doesn't need to be changed or defended. The diversification is the defense. The VX-US allocation adds international exposure that may behave differently from US equities during a domestic recession. And the BND allocation provides a stability anchor that dampens overall portfolio volatility during the drawdown. The three-fund structure from Video 10 wasn't designed for good times. It was designed for exactly this. Second, the automatic contribution from Video 8 continues buying shares at lower prices during a downturn. This is the most counterintuitive and most powerful feature of the system during a recession. If the market drops 15%, the monthly $500 buys more shares at a lower price. Those shares purchased during the dip compound for every remaining year of the investor's timeline. The person who pauses contributions during a recession misses the discount. The person who doesn't notice because the transfer is automatic gets the discount every month. If you've ever wondered why the series spent an entire video on automating the transfer, this is the reason. Automation removes the decision. And removing the decision during a recession is worth more than any hedging strategy, any market timing attempt, or any tactical allocation shift a financial advisor could suggest. Third, the protocol from Video 24 applies without modification. Check the transfer, track the number, decline the offers, name the milestone. Do nothing to the portfolio. The protocol doesn't change because the economy softened. The protocol was built for exactly the moment when the economy softens and every instinct says to react. The leading indicators may be flashing. The credit data may be alarming. The unemployment number may be hiding 1.5 million missing workers. And the correct response to all of it, for the long-term index investor with an automated contribution and a diversified portfolio, is to continue running the protocol exactly as it was designed. If you're feeling the gap between the official numbers and your own experience, that feeling is valid. The metrics are measuring something. They're just not measuring what most people think. And the gap between measurement and reality is where recessions live before they're officially declared. The person who understands this, who sees the leading indicators, who recognizes Goodhart's law in real time, doesn't panic. They recognize that the system was built for uncertainty. The architecture holds during growth. It also holds during contraction. The compound curve from Video 15 doesn't stop working because GDP slowed. It continues working because the contributions continue, and the time continues, and the math doesn't change because a headline changed. When the NBER eventually declares whatever is happening right now, whether it's a mild slowdown, a technical recession, or something else entirely, the declaration won't be news. It'll be confirmation of something the leading indicators already showed and the lived experience already felt. And the person who built the system, who followed the protocol and who didn't sell during the gap between reality and official confirmation, will be the person who comes out the other side with more shares, a larger base, and a steeper compound curve than the person who reacted to the headlines. The system holds. It was built to hold. The only question is whether the person holding it trusted enough to let it work.